I'd like to welcome Mitch Harwood from SW Brokerage, one of our top brokers actually, who's just really come into his realm in the 2024. No stress, mate, no stress. Very proud of what you've achieved this year. So, mate, I want to talk about, if we can, which I know that you're great in. We get a lot of good feedback about this, first home buyers, and particularly what banks look for when applying a loan. So with interest rates looking like they're coming down in 2025, we want to know from who you've helped in 2024, if that we could. Yeah. What opportunities in 2025 should people be looking at? And really, what do banks look for when you're applying for a loan? Because that's the myth, right? And God, we could probably spend hours on talking about that stuff, but I just want to talk about it from high end, mate. So look, I'll give you the floor and then we'll just chew the fat, of course.
Sure. Yeah.
So mate, first home buyers, and then we'll finish off, say, maybe 3 tips if that's cool for 2025.
Sounds great.
Okay, mate. So let's start off with the first home buyers.
Okay.
You cool
First
with that?
home buyers, absolutely. So
who did you help this year?
Well, who did I help? I mean, I've helped a lot of first home buyers. That's as you said, it's kind of one of the things that I don't want to call it a niche because I help everyone, but they are some of my favorite clients to deal with because I really enjoy not just helping them get a loan, but kind of educating them. You're kind of dealing with people who have never had or mostly never had major assets before. So you're not just saying, hey, you want a loan, here's a loan. You're saying, hey, you're in your 20s, 30s. Where do you want to be in 30 years? And what kind of goals do you have that we need to take into account? Because you're not just getting them the loan for this property they're buying, you're setting them up for the future. So I really enjoy doing that and educating them about finance, which I find gets really good feedback. So yeah, I've helped quite a few first home buyers this year.
Have you got a story, mate?
Yeah, I was just about to say, I'm going to tell a story about some first home buyers. Don't we all? A story about some first home buyers that I helped who basically didn't think they could buy a house. And once I spoke to them, it turned out that they could. So I had some first home buyers who had gone directly to one of the major banks. And basically, they wanted a pre-approval, which is essentially where you go to a bank before you've found a property. And you give them all your information and they say, yeah, in theory, we'd lend you this much. Come back to us when you got a property. So they basically do the assessment of all of your finances up front and then you give them the property later. But that major bank basically said you can't borrow anywhere near what you want to borrow. So really, you're going to have to wait, save a bit more and earn a bit more. And then they came to me and said, hey, this is what this bank has told us. What do you reckon you can do?
Did the client did the client actually go into the bank or was it more of a phone call with that bank?
They made an appointment. They had an initial phone call, but they actually went in and spoke to someone who pretty much said, who said, we can't help you. But
so they said it was, sorry, mate, they've taken an hour and a half out of their time, travel time, of course, to go and speak to the bank.
Yeah, absolutely. But even then, they said it took them a while to get an appointment because apparently major banks don't have heaps of staff on hand anymore. So I think they had to wait about a week and a half to even speak to someone and then spoke to them for a while and then was told, this isn't going to work. Come back in a couple of years. So they came to me and said, look, we've heard good things. What can you tell us? Are we able to borrow more than this or is this it? So I spoke to them, went through all of their finances, their goals and circumstances and did some research. And basically I was able to help them borrow significantly more than they had been told. And they were shocked and said, how can this be the case that this bank has told us you can only borrow this amount and you're telling us we can borrow way more?
Were they skeptical?
A little bit, right? A little bit, because I think they think, oh, what's this person pulling? Have they done something dodgy? Like, surely my numbers can't be that different to the bank's numbers. But really, it came down to 2 major things for these clients. So number one, different lenders treat income differently. So one of the clients got quite a significant bonus every year, and a lot of lenders will only use your bonus if you've got it for a certain amount of years, and they will average your bonus over the last couple of years. So if 2 years ago you got a $1,000 bonus and last year you got a $50,000 bonus, a lot of banks won't use it at all. A lot of banks will use the average, which is, $25,500. Whereas we found a bank that would use the entire most recent year bonus. So that increased their income on paper significantly. And that was a bonus that was going to be recurring. So there really was no reason not to use it. So with the bank I found, we were able to use a lot more of their income. And the second thing was different lenders treat expenses really differently. So a lot of first home buyers at the moment are looking at townhouses and apartments. Now, townhouses and apartments have body corporate fees, and certain banks treat body corporate fees as a special expense. So they'll look at all of your expenses that you've declared and then say, well, we're going to add $300, $400, $500 a month on top of that in body corporate. Whereas some lenders will now allow you to just include that as part of general expenses.
So it's actually within the HEM?
Within the HEM.
And HEM is?
HEM is the household expenditure measure, which is essentially what banks use to say what they think your expenses should be at a minimum based on whether you're single or in a couple, how many kids you have, how much you earn, and where you live.
But a lot of people are thinking, oh, shit. My expenses be a lot higher than what they think.
Absolutely.
Yeah.
And it can happen. I mean, there is quite a lot of variances. Some people spend a lot less than HEM. Some people spend a lot more than HEM. But it's just kind of a guide. But obviously, if you're a bank that puts body corporate above HEM, so you're saying that these people actually have $500 more expenses than another bank calculates it, even though they've declared the exact same to you, your borrowing power is going to be a lot lower. So the bank I found used more of their income and didn't hold this body corporate against them, which the first bank did. So basically, long story short, these clients went to a bank, were told, hey, we can't help you, come back later. They came to me and I found a lender that actually could help them, and we got the deal across, and they've moved into their house. They're very happy. And
was it a house or townhouse? Sorry?
Oh, sorry, townhouse. It was a townhouse, yeah. And as luck would have it, so they moved in about 2 months ago, and just last week, on Monday, earlier this week, one of their friends called and said, hey, such and such referred me to you because they were really happy. So, I feel like I did a good job. They're referring their friends to me. So,
that's a big thing.
That was a really good outcome.
So if you go back, I don't want to bank bash, but I will. It would come down to a lot of people probably don't understand that people within the bank, they probably just they pluck them from areas of the bank, just probably put them in positions to a degree, right? Mm-hmm. Out of interest, the bank that they went to, did you go to that same bank?
No.
You went to a different bank. No. Was it a mainstream bank?
Because it was a major bank.
And they went to a mainstream bank initially?
The bank they went to initially was one of the big banks, and the bank I sent them to was also one of the big banks.
No way.
But the bank I chose just had a better policy that suited these people. And I mean, that's one of the big lessons is each bank has different policies. That will mean your borrowing power is way different. What kind of deal they're willing to give you is going to be way different. If you go to a big bank, they can only tell you, this is our deal, this is our policy. If you go to a broker, they can say, hey, here's 50 banks I can talk to, and I'm going to find out who can actually do what you need. So I think that's the lesson I would take from that one is speak to a broker, because a bank can only tell you what they offer. A broker can tell you what the whole market can offer you and find you what's best for you.
So they got you got a pre-approval first?
Yes, pre-approval first, but it didn't take them long. We only had the pre-approval for a couple of weeks, and they found a place really quickly. Yeah.
So now talking about that, so given that what would be some tips that you would give first home buyers when searching for a property? So first and foremost, they're going to come and see you, 100%, right? Mm-hmm. If not, look at our Google reviews, jump on board, look at Mitch on the website, swbrokerage.com.au, scroll and have a look for his face and hit it, and you'll connect with him. So what are some tips you give first home buyers, mate, when looking for a property? Mm-hmm. They've already got the pre-approval.
They've already got the pre-approval?
Through you. They've already got the pre-approval through you. What do you tell them when they go hunting?
It really depends on their circumstances and what they're looking for. I suppose if they already have a pre-approval, the thing is you get a pre-approval for a certain amount. So you can borrow a certain amount and your purchase price is a certain amount based on your circumstances. So if you're trying to negotiate a contract when you're making offers, you already know your max. So you can't go over your max. You can't offer more money. So I suppose clients think, well, what can I do? If I can't offer more money, what can I do to make my offer more attractive? And one of the biggest things is offering a short finance clause. So finance clause is a clause in the contract that says you have X amount of days to get finance through a bank approved. And if you can't do that, you can pull out of the contract with no penalties. Now, the standard finance clause in Queensland is 14 days. That's what most people use. But that is a bit of a risk to the seller, because that means they've signed a contract and then 14 days later, the buyer could say, actually, we couldn't find finance, we're pulling out. And then the seller has wasted 14 days. And they might not have 14 days. They might be looking to buy another place and they need to sell their place as soon as possible. So even if you can't offer more money, sometimes offering a short finance clause from 5 to 7 days will work. Now, if you don't have a pre-approval, it's very difficult because 5 days is not a whole lot of time. But if you already have a pre-approval in place and you speak to your broker, who is hopefully me, and they say, yep, 5 days is fine, we can get this through, then even if someone else has offered more money, you might be able to win the house that you want or the property that you want because you've offered better terms.
So you know, like I think it's important to remember as well, like you've solidified a relationship with these people, right? So there's trust there. So, you know, in 2 or 3 or 4 or 5 years' time, once they've got a bit of equity or they might want to do something a little bit further, you're there, you get to know their situation, right? Or if there's a cheaper rate out there, which a lot of people do see online. One thing I will say is that being brokers ourselves is that talk to us as well, because there tends to be a catch, right? And that there is like, okay, you might get a cheaper rate, but the bank may be more conservative, so that'll restrict you down the track. So, mate,
sorry to interrupt, but you actually brought me onto a good point that I was thinking of. It's about the relationship moving forward. So if you go to a bank, even if you speak to someone in person, chances are you're not going to deal with that person moving forward. There's going to be a bunch of different people you have to speak to. If you meet with a broker, you're going to speak to the same person every time. You probably have their phone number, like their mobile number, so you can call them directly. You can email them directly instead of calling, you know, a 1-300 number to speak 100%. To such and such in a call center at a bank. And essentially, brokers have not an obligation. Well, they do have an obligation, but brokers have an interest in keeping you happy. So brokers get paid the same regardless of what your interest rate is. So I get paid the same if you get an 8% interest rate or a 6% interest rate. So obviously, I'm going to try and get you the best rate that I can because it makes no difference. Banks and bankers make more money if your interest rate is higher. So they have an incentive to not give you the best rate. Yeah. They want to get you in the door and keep you there, but still want to make as much money as possible. I want to get you the deal that suits you. And if it's not the best deal for you, I'll move you somewhere else, because it doesn't matter to me from financially. It doesn't matter to me if you pay, it doesn't help me if you pay a higher rate. It helps me to keep you happy because I want to make sure my business is going to keep going. You're going to be happy. You're going to recommend me. So it's in a broker's interest to keep you happy and do what's best for you. It's not in the bank's interest to do that. They just want to keep you on the books.
But I'd say that's a good point, right? We're more evolving from your mortgage broker to your finance broker as a business, right? Because we've been for so long, and plus our wealth of knowledge goes quite deep. I think it's important to remember as well, Mitch, like for us as well, is that we solidify a relationship. Then the client, you know, goes off, pays their mortgage. 3 or 4 years later, they're chapping on our door, or they're talking to someone that's done something, or, you know. I think it's important to remember that they can always reach out to us to help them, guide them in some way, shape or form. Yes, you need an accountant. Yes, you need a financial planner. Yes, you need a stockbroker. Hey, by the way, if you want to do that in the next 3 or 4 years' time, this is the bank that we've got to be with, right? So I think that's the attributes of coming back to, you know, solidifying that relationship. And I think it's really, really important that first home buyers remember that.
Absolutely.
And even people that are buying again or buying again, whatever it may be, once you get yourself a good broker, it's like having a good dentist or a good doctor or a good mechanic. You kind of want to solidify that, right? So, mate, this brings me to my other point, is that let's look at it collectively, not, you know, for first home buyers I know we're talking about here. What are some of the things that banks look for when you apply for a loan? Because people might Google it, but there's a lot more to it. If we just, without the paperwork, because I know there's a lot of paperwork involved, but what do banks look for, mate?
Yeah, there are a bunch of different ways to categorize how banks are going to look at things and what categories of things they want. But the way I generally break it down is there are 5 things that banks look at. So you've got income, expenses, assets, liabilities, and character. So your income, how much money do you earn? And even within that, different banks treat different things so differently. Like I said earlier, some banks will use a certain amount for bonuses. Other banks won't use bonuses. Some banks will use 100% of rental income. Some will only use 70% of rental income. So even though you think, okay, income is money in, it is a bit more complex than that, and a broker can help guide you there. But basically, how much money are you getting in is the first thing banks are going to look at. 2, what are your living expenses? You know, do you live quite frugally and you only really spend what you need to and you're a good saver? Or do you live paycheck to paycheck? Because banks are going to consider that, and seeing what your living expenses are will impact how much they're going to lend to you. What are your assets? So when you're looking at assets, banks like you to have something there, whether you have, it doesn't necessarily mean you need 100 grand in savings, but just to show you've got, you know, a bit of furniture, maybe you have a car, maybe you have a couple grand invested in shares, something like that. They'll look at your overall position. That doesn't mean you can't get a loan if you don't have heaps of assets, but they will take into account your asset position and how much deposit you're able to put down on a property if you're looking to get a home loan. And then finally, liabilities. So those are your current loans. So if you have a car loan, if you have a credit card, even if you have buy now, pay later, that's considered a liability. So banks will look at how much money's coming in, how much money's going out for expenses, what assets do you have, and what other loans do you have. Stick that all in their calculator, and that will kind of roughly tell them how much you can borrow. But then you've got the fifth thing, which is character. So it's not just about the numbers, it's also about you as a person. So what does your credit history look like?
Banks don't tend to treat people that way, but anyway.
Well, I guess not you as a person. Like, they're not going to want to sit down and if you can make them laugh, they'll lend you more. But they want to look at what kind of financial character you have, I suppose. What's your credit history? If you've had a credit card for 20 years or 10 years and you've never missed a payment, that's good. That helps you. If you've had, some loans before and you've repaid them all, that's good. If you have had loans before and you've had late payments or you've had a default or a company had to sue you because you didn't pay them what you owed, that's bad.
Yeah, that's not good.
And even if your income and your expenses, your assets and your liabilities all look fine, if you've had major credit issues in the past, you're a big risk. So that might be a deal breaker in getting you a deal from a bank.
Brings me to just one thing before you keep going is Equifax is a big player in it. I mean, I don't think people quite understand how your credit file is so important to you.
Yeah, absolutely.
Equifax, equifax.com.au. I'd highly encourage anyone to get on there to do a credit search of their own. I think you can pay $9.95, I do, every month. And anyone that hits on your credit file, you get an alert. Because we both know when talking about the character. So we get a first home buyer, comes in, they've got they've moved from house to house, haven't paid a phone bill.
Yep.
That will flash up. Mitch, that's a deal breaker for initially. And then to try and get it off the credit file, they could have missed out on that property.
Oh, yeah, absolutely.
So that's one thing I think huge for the listeners out there is that people need to understand that when applying for a loan, mate, you keep your credit file completely clean as much as you can.
Absolutely. Absolutely.
So what's a good credit score, Mitch?
It depends. I mean, how long is a piece of string? So credit
Where should
scores,
it be?
A perfect credit score is around 1,000. So if your credit score is around 1,000, that's amazing.
You're good.
You've got no issues. If you got a credit score under
700?
600?
600, okay.
Or, between 600 and 700, it's probably not a deal breaker, but it's not amazing. Anything under 600, you're definitely going to have to get creative. So, it depends on the lender as well. So some lenders don't credit score, but they tend to be the alternative lenders who are much more expensive, have higher fees, higher rates. Like, having a poor credit score doesn't necessarily mean that you have no options, but it just means you're definitely not going to get a deal that's as good as someone who had a better credit score.
I just want to circle back to, and thanks for covering that from what the banks look at. Mate, just want to touch upon, if we can, from a helicopter perspective, is that look from a first home buyers, interest rates coming down next year, which is great. Opens up so many more opportunities. We know the government's actually trying to do further things with the stamp duty, with construction.
Absolutely.
Mate, from a first home buyer, the schemes. Talk to me about the schemes. How many schemes have we got available?
So there's 4 main schemes for first home buyers in Australia. Even though they're essentially the same schemes Australia-wide, they do have differences in states. So when I'm saying numbers, that's mostly going to be Queensland-based, but it really depends. Number 1 scheme is the Home Guarantee Scheme. That is for first home buyers that are buying a house that they're going to live in, so owner-occupied, not an investment property. Generally, you've probably heard you want a 20% deposit, otherwise you'll have to pay mortgage insurance and higher rates. The Home Guarantee Scheme is a scheme from the government that basically says to banks, hey, as long as these clients, these first home buyers have at least 5%, we want you to treat them like they have 20% and we'll guarantee you the difference. So if something goes wrong and the bank loses out money, the government will cover the bank's losses there. So the bank essentially will treat you like you have 20% even though you only have 5%. So that not only does that mean you can potentially get a better rate, but also if you're not paying mortgage insurance, that means that you're able to borrow more, because if you have to pay mortgage insurance, your borrowing power goes down, your rates go up. So that scheme, so many clients of mine, literally, if that scheme didn't exist, they would not have a house now, but they have one because they use that scheme. So it is really good. In Queensland, the cap for that scheme is 700,000. So, at least in metro areas in Queensland. So look, you're not buying a mansion as your first house if you're using that, but that's not the point of the scheme. The point of the scheme is to get people onto the market. And once you're in, it's up from there. It's getting your foot in, and I've used it so many times with clients. It's great.
I think the big thing is to remember, like you just mentioned before, everyone's got to start somewhere. Mm-hmm. I think that's the important part here, right? Like, I think the demographics I think the mindset needs to change. I'm going, just to chew on the fat now. The mindset needs to change. Like we've got affiliation with a leading construction company here in Queensland, Brisbane, Bold Living. Mm-hmm. I've personally gone around to every corner of Brisbane of probably in the last 3 or 4 months. If you go out towards the Cleveland way, you're taking down the Gold Coast, turn left. There's so much land there, it's not funny. And you're not that far away from the CBD, right?
Absolutely.
You can still buy a house there for $800, $850 as a first home buyer. But everyone has this mindset that we need to be 10Ks or 8Ks. Yes, statistically, that has been Brisbane's statistics for a long time. Mm-hmm. The population's going to grow. We will become a little bit more like, your Melbournes, your Sydneys, where more people are flooding here. Yeah. I think with the first home buyers, it's that they don't need to buy that dream home straight away.
Yeah. Absolutely.
I mean, I'm 47. I've had a couple of houses in my past, and it's like the first house I had is certainly different to obviously the evolution of time, right? Mm-hmm. So, but you got to start off somewhere.
Absolutely.
You got to establish that, and there's good incomes coming into it. It's like, hey, how do you buy something, do it up, maybe move it on, or do it up, and you'll get equity, or go harder at paying off your home loan. Yeah. I don't think people actually realise, and I did one on debt consolidation just before, is that even paying an extra $300,000, I did one just before, like let's just say you had a 25-year term and you push your loan back to a 30-year term to debt consolidate, right? Mm-hmm. And you pay an extra $300 per month off your mortgage. That will bring it back down to 25 years. So just a small extra repayment. Yeah. It may not seem, it's only $200 or $300, but that is huge over probably a good 4 or 5 years' time.
Oh, it adds up massively. And I don't want to get too much into maths, but compounding interest, you think if you pay an extra $200 now, you're not just paying $200 off. That $200 you won't be paying interest on for the next 30 years. And any interest that would have been charged, you're not paying interest on that either. So huge, even mate. Like it sounds, like you said, it sounds like a small amount, but the difference it makes is insane. Yeah. I think the numbers are about, because we talk about recommending as well fortnightly payments instead of monthly. Have you talked about that at all?
Not yet. No, please go on.
So most or almost all banks, no matter what your repayment frequency is, or like no matter whether you want to pay it weekly, fortnightly or monthly, their contracts are always monthly. That's just standard how it's done. I think there are 1 or 2 banks that will actually put in the contract your actual weekly or fortnightly, but the vast majority just have monthly. So if you switch to fortnightly, the amount you have to pay each month technically stays the same, but you've just switched the frequency that you're doing it at. Now, most banks, when you pay fortnightly, don't just take your yearly amount and divide it by 26. They will take your monthly payment and divide it by 2. Now, that sounds like it's about the same, but actually it's not, because there's not 2 fortnights in a month. 2 fortnights is 28 days, right? Most months have 31 days. So if you do it that way, technically you're paying off an extra monthly repayment every year. And the difference really is so small, because instead of paying 1 payment a month, you're paying 2 payments per fortnight. It really feels like the same, but at the end of the year, you've paid off an extra month. And it really depends on the rate and the exact loan amount and that kind of thing. But basically, if you did that from day one, you are paying off your loan about 7 years earlier. And on your average home loan, you're saving hundreds of thousands of dollars. Like, it's actually an insane amount. And most people don't even notice the difference.
No, they don't. They don't. And I know interest rates are coming down, as we know, right? If you can afford to keep paying what you're paying right now in 2024, the rewards that you will reap, the rewards that you will reap are life-changing moving forward, right? Like, absolutely. I get this feeling, like we've got so much coming at us now. Like, we've seen Bitcoin, which that's one thing I probably want to speak to you, because the age demographic that you deal in, they're probably talking a lot about Bitcoin and how do we make more money, and it's like getting rich quick, and how do I pay that off? It's kind of like go on to the old traditional values, I feel. I'm not saying everyone's like this. It's like putting a bit of patience behind it, putting a plan in place to go, let's just say from a first home buyer's perspective, the budget is a fundamental part of any financial success. Yeah, it's the pillars of everything. It's the foundations of everything. It's like, how do you then go, right, here is what I'm going to put a little bit extra on my mortgage, like you just mentioned. I'm going to change to fortnightly because it's going to save me. I statistically shown people buy a new car when they buy a house 6 to 7 months later.
Yeah, they do.
Do you need that type of car, right? So it's like, yes, you can invest into Bitcoin. Bitcoin's going to be, so they say, the next big thing. People have made some really good cash on it.
I don't know if it's the next big thing. I feel like it's already
the big
here,
thing,
isn't it?
That's true. Or do you go into the ASX? So if you go back a few steps before, it's like, it's imperative where I find broking. I mean, traditionally we used to be called mortgage brokers, but that's why I say finance brokers, because mortgage broking is completely evolved. If you haven't got something extra in your repertoire, you're just an interest rate kind of broker.
Yeah.
Right?
Yeah.
So we get that, right? But the first home buyers out there, Mitch, if you could give us your top 3 tips and also what top 3 things would you like to discuss that's really exciting for you moving forward in 2025 that you want some people to hear?
Okay, sure. First home buyers, I guess the number one tip is know the schemes that you could use, because you can only use them once. And once you bought a property, you can't use them again. So before you make a decision, know what schemes you can use. I don't know. I'll just briefly touch on the other ones we haven't touched yet, because I feel like that's the first thing to do. If you don't know what the first home buyer schemes are, speak to us, because we know what they are. We can give you advice on them. So we've already talked about the home guarantee scheme. There's also the stamp duty exemption. So stamp duty is a tax that you pay in Australia when you buy property. So the buyer pays it, and it's essentially just a tax to the government. Now, if you're a first home buyer and you are buying a property for $700,000 or under, or those are the numbers in Queensland at least, you will pay no stamp duty. And it's a huge amount. It's about $14,000 that you're saving. So imagine if someone just chucked 14 grand in your account and you could use that as part of your deposit. That's the difference that this is making. If you buy a place for between 700 and 800,000, you only get a partial exemption. So the closer you get to 800, the less benefit you get from it. But there's still a little bit there. But basically, if you're buying something on the home guarantee scheme where the limit is 700 anyway, you'll also automatically qualify for the stamp duty exemption. So it just means that you can get into your house a lot quicker. I mean, I had clients that I had to say, oh, look, I don't know if you're ready to buy yet. And then as soon as the stamp duty exemption or the home guarantee scheme increased to 700 and they didn't have to pay stamp duty, they were able to get in much quicker. So it really does make a huge difference. That also, I will touch on, this hasn't happened yet, but as we all should know, LNP just won the election in Queensland, and one of their campaign promises was they will get rid of stamp duty for all brand new properties for first home buyers. So right now, it doesn't matter whether your property is new or not for stamp duty. It's just 700 is the max for the full exemption, 800 is the max for the partial exemption. But moving forward, for people who are buying their first home and they are buying a home that is worth more than that, so they don't qualify for the other schemes, you may be able to buy a property for significantly more than 700,000 and still pay no stamp duty if it's brand new. Now, that was one of the LNP's campaign promises. They haven't officially put it into policy yet. There's no specifics around that, so we'll have to wait and see. But this potentially could be a big game changer for young people who are making, say, really good money and do want to just start out buying something a bit more expensive.
Plus also, just to talk about that with the LNP, I think that 2025, once that comes into play with the schemes, mate, it's a bit of a golden ticket, right? And I think the mentality needs to change in terms of like where they're going to go and build. But I think it's an exciting opportunity, mate. If I had kids of the age right now that were first home buyers, telling them to be waiting for the scheme to come out. Sorry, the scheme is already out, but I'd be waiting for the stamp duty, and I'd be getting them into an established house as quickly as I could. 850. Be perfect. And the infrastructure will change here. I have no shadow of a doubt. Yep. But I know a lot of people are buying units and townhouses as first home buyers as well. But mate, just the other schemes that you got?
Sure. So the next one is the first homeowners grant, and that's only for brand new properties. So every state does have some kind of grant. I think it's called different things in different states. In Queensland, it's called the first homeowner grant. Basically, if you buy a brand new property or you build a property yourself and you're a first home buyer, the state government will give you $30,000. So you can use that, you can get that in cash after it's built, or you can use that as part of your deposit. So it's basically just a cash grant to encourage first home buyers to build. Right now, the cap on that is $750,000, but look, it wouldn't surprise me if that increased a bit because obviously costs for building can be a bit high at the moment. And as you said, everyone's hopefully going to look to build. We're wanting to build more houses. So yeah, that's a really good one. If you're a first home buyer and you're looking to build a house, definitely look into that one.
Unbelievable.
Yeah. And then the final one is the Super Saver Scheme. Now, this one is the same across the whole of the country. So this isn't just for Queensland. Basically, if you make voluntary contributions to Super, you can get a tax break from it. So Super is only taxed at 15% when you make contributions. If you earn enough money that your tax rate is higher than 15%, you're obviously saving tax by doing that. But you can also pull out $15,000 per financial year up to a total of $50,000 and use that towards a first home. So what I find is a lot of government workers automatically make extra super contributions. So I worked for the government for a while and it was just standard. You automatically made extra super contributions unless you cancelled them. So
just to go over that, right? So if you can take out, if you're paying extra into your super, up to $15,000 in 1 year.
Up to $15,000 in one financial year and up to $50,000 total. So say in the 2022 financial year, you put in 15 grand, 2023 financial year, you put in 15 grand, and then this year you put in 15 grand. You could pull out all 45, but not just the 45. You can also pull out that money has made. So you'll actually be pulling out most likely more than you put in. So yeah, it's quite a good scheme. And essentially, it's almost like forced savings, I suppose. If you chuck $200 a fortnight in there, that just keeps rolling, keeps growing, and then when you're ready to buy a house, see how much you can pull out.
So any government workers out there wanting to deal with Mitch, if you've been doing it for a while, let us know. If not, it may be something you might be looking at doing in the next couple of years.
Absolutely. Yeah, if you're a government worker, you might already have heaps in there. If you're not, it's something that you can organise if you haven't done it before, for sure. So those are the main ones, the main schemes that we use. So if you want any more information about that, get in touch with us. So my number 2 tip is get a pre-approval. Now, we already touched on pre-approvals. Basically, you say to the bank, hey, here's my income, these are my goals, these are my circumstances. Will you lend me this amount of money? And they say, yep, in theory, based on what you've told us, we can lend you this money. Come back to us when you got a contract. And then you go back to them with a contract and most of the hard work's already done because they've already assessed all of the information. They just need to make sure, hey, is this a property that we are happy with? Because obviously not all banks are happy to lend for all types of properties. But really, it just means you can be a bit more secure. I mean, it's not a formal approval. It's nothing set in stone.
It just gives you an idea.
Absolutely. It gives you an idea of what you can borrow and gives you a bit more security.
But I also think as well, Mitch, it's important to remember, like pre-approvals, I'm not saying all the banks are like that, but it doesn't really get past sometimes the gatekeeper. You know, it can be like an automated system, right, that the banks do. I know one of the biggest major in the country just puts it through a system. You know, there's no kind of... there's no vetting, there's no character, it doesn't go through to the keeper as such. So I think a lot of people have got to be really mindful as well, is that even though you might do a pre-approval online, it's important to probably delve a little bit deeper to make sure it's the right product, it's the right rate. Is it got an offset account, it's got a redraw account? Is that the right bank? Because I feel that a lot of first home buyers will purchase, let's just say you get a 95% or 90%. You're actually tied to that bank for a number of years.
You can be, yeah. You
know, and just to turn around and go, I'm just going to refinance if they're not the right one to me. Well, you're cutting off your nose to spite your face there because of the costs, right?
Yeah.
Associated to refinance.
I mean, and sometimes refinancing isn't even an option.
No, that's right.
If rates have changed or your income's changed, you might not be able to refinance.
And probably getting down to the education part before, that's what you mentioned, that, that's probably one of the things that I love about us. And then that's probably what I believe differentiates us to a lot of other broking firms, is that the education is a huge part. So let's just say you're a first home buyer, you borrow 90% or 95% on a property. Within that time of that, then there's no growth. Let's say there's no growth for another couple of years, rates coming down, extra cash, right? People will tend to probably go and buy a car, take a credit card out, go on a holiday.
Yep.
And they, they're kind of somewhat trapped, right? And then they go, I want to deconsolidate. Okay, well, you're still stuck at that bank unless you have 80% or 20% equity in the property. So for those people that are out there, particularly the first home buyers, and I'm talking about first home buyers at the moment because if rates are coming down, you can purchase a property, but I'm talking about 2027, 2028, that just be really mindful of the debt that you're in and the debt that you can go in terms of buying a car, getting a credit card, taking out debts. I mentioned before, Mitch, and I'm not sure whether you know this, is that the Australia has risen household debts over the years to a total debt of $2.5 trillion worth of debt. That is including interest, credit cards, personal loans, pay now, buy later, that kind of stuff. Sorry, buy now, pay later credit cards. So I think that there's a lot of traps out there for first home buyers, isn't there? That they don't. It's not just this purchase. It's you got to think about 3 or 4 or 5 years down the track.
Absolutely.
Or with what they're doing.
Absolutely, yeah. And that's the thing. Like we said before, we want to educate you so you're making good financial decisions and setting yourself up to succeed financially in the future and not trapping yourself somewhere.
Mitch, 3 top tips, mate, for 2025. Rates coming down from a finance broker's perspective. Mate, what opportunities are we going to see out there?
Yeah, I suppose the 3 things that I would be looking for in terms of opportunities. Well, number 1 is you're going to have better borrowing power. So your borrowing power is determined by obviously how much you earn and then what your expenses and your liabilities are. If rates come down, it means that your repayments are going to be lower. The lower your repayments are, the more you can borrow. So it means a lot of first home buyers who previously couldn't borrow might now be in a position to borrow what they want. But it also means that people who were looking at maybe getting an investment property, but they thought, well, you know, I'm only going to earn this amount of rent and my repayments are going to be way higher, so it just doesn't work for me. You know, if rent stays where it is, but rates start coming down, then maybe an investment property is going to be a much more realistic option for you. So better borrowing power is going to help people looking to buy a home to live in, but it's also going to help people who are looking to buy an investment property potentially. I suppose number 2 is there's more competition. So when rates stay the same, banks don't tend to aggressively give good deals and pricing and that kind of thing because they're really just stealing the same clients back and forth from each other. When rates are moving, that's when you've got opportunities to really get in there. So during COVID, when rates were rapidly rising, you had refinances left, right, and center because banks were really wanting to take an opportunity of these moving rates and giving special deals and that kind of thing. If rates start coming down and rates move often, that's when the banks, I think, are going to be more competitive. So it's more important than ever to look at your rate and say, hey, let's have a look and see if there's something better out there. Cool, so I think there's going to be a lot more opportunities there. Yep. Number 3 would be consolidating debt. So as, you know, if you have a credit card, that's going to be high. Your average credit card is about 20% interest. Personal loans, it depends, but they can be 10% interest in the teens. So a lot of people like to consolidate debt into their home loan. And if home loan rates keep coming down, then it makes more and more sense to take some of those debts and potentially consolidate them in. Because if you owe $5,000 on a credit card, why would you pay 20% when you could be paying 5% if you consolidate it into your home loan? So it just means I think there's going to be more opportunities for people to structure their finances better to make sure that they're not paying more than they have to. We've talked a lot about first home buyers, but I don't just do first home buyers. I feel like our conversation has just kind of gone that way. But as I said, I cover everyone, and these are actually an older couple who had their loan for a very long time already. So I had these clients who had been with a major bank for 17 years. So a standard loan term is 30 years. So more than half their loan, a huge amount of it had been paid off, but they still owed quite a bit. So they still had 13 years remaining. Now, they contacted me because I actually had a client who worked with one of them and recommended me. So kind of contacted us out of the blue. And they basically said, we want to know if we can refinance to a better rate. How's our rate looking? And I said, okay, sure, we can talk about that. What rate do you want? And they said, 8.2%. Oh. And I said, what? 8.2%? And they said, that's bad, isn't it? I said, that's insane. I said, you know, the average rate at the moment is low to mid 6s. So 8% is crazy. And I kind of said, how did you get here? And they said, well, we got a good rate when we first signed up, and then we just haven't really looked into it. The banks never offered to review our rate, and I guess it just kind of crept up. So I said, okay, well, let's have a look at everything. Because even though that rate's crazy, you obviously still need to look at the income and all of that to make sure they qualify for a refinance. And they did, thankfully. I managed to move them from 8% to 5.99%. I think it was at $200,000. So it was smaller than your average mortgage would be now, but still a significant amount. So, you know, 2.2% or whatever I save them per year. Are you going to work out how much interest that is? Go for it. I should have written that down. Hey,
how much was it?
8.2 down to 599 for about a $200,000 loan. So
200,000, 2.21. So you saved them $4,420 in interest per year.
Per year, yeah.
So that's $370 per month. $370 per month. Holy Toledo.
Just interest. Like, interest is just money down the drain. So yeah, even though their loan amount wasn't that big, the change in interest was so big that it made such a huge difference. And look, they were stoked when I did that, very happy. But then I spoke to them, have you ever heard of the term loyalty tax? I know you've heard of it. So that's what we in the industry call the extra money that you pay by being loyal to your bank. Because so many people think, oh, you know, I can trust my bank. I've been with them since I was a teenager. Or a certain bank, you might have opened an account when you were about 7 because they came into your classroom. But people think, I'll just trust them. Like, I've been with them my whole life. They're going to take care of me. I'm loyal to them, so they're going to be loyal to me. The reality is they're not loyal to you. Banks give the best rates to brand new customers because they want to get you on their books, and customers who they think are going to leave because they don't want to lose the business. The customers who have been with them for 20 years and aren't going anywhere, why would they give you a better deal? They know you're not going anywhere, so they'll just keep putting your rate up and up and up and creeping up, and there you go. And that's what happened to this couple, unfortunately. So yeah, they didn't really question it. The bank never said, hey, let's review your rate. This is looking a bit ridiculous. It wasn't until they came to us and we said, yeah, that's crazy. Let's look somewhere else. So I think the number one thing to look at there is don't pay loyalty tax. If you haven't spoken to someone in the last 2 years to review your rate and make sure it's competitive, that's crazy.
Mate, there's a lot of brokers that are great. 100%, 70% of the market goes through us, right? But I even find with a lot of brokers, mate, don't even do that. And I think if you haven't heard from your broker, mate, get onto them or look elsewhere. 100%.
Absolutely.
If your broker's not keeping in touch with you once a year just to review your rate, it's huge.
Absolutely. And that's something that we do really well.
We do.
Every year, we will contact you on your anniversary and say, hey, we're just going to speak to your bank on your behalf and see if there's any extra discount we can get off. Now, sometimes they might not offer anything, but a lot of the time, just by us making one phone call on your behalf, we will save you money.
One thing I have to admit is that I do love helping people in the refinancing sector. I really love it getting to the point where you've achieved the cash flow, because the cash flow is going to then give you that perfect sounding board or the perfect pivotal board to look at opportunities. You know, like getting the cash flow better, taking out maybe a little bit of cash to look at investing with financial planners guidance, of course. But, you know, look, there's so much more opportunity out there.
Yeah, absolutely.
I just find that people get complacent, right? Like, say that couple, you know, they've been paying 8% to that bank for so long. It just blows my mind. And I have no shadow of a doubt, with all due respect to those clients, they would have been complaining about the price of fuel, would have been complaining about the cost, would be complaining about electricity. However, they're paying an extra $4,500 per year to the bank.
Yeah, absolutely.
But yet they've complained about other stuff, right? So if you're listening and you're out there, honest to God, debt consolidation, refinancing, touching base with us, we can give you an idea in terms of getting you in a better position in terms of what else is out there, right?
Absolutely.
For a 5 to 10 minute phone call can save you thousands.
Absolutely.
Mate, thanks very much for popping in to the podcast, and we'll be putting stuff online as well. Is there anything, mate, that's out there that you'd probably wanted to speak about before you sign off? And tell anyone about 2025 besides coming to see Mitch Hardwood from SW Brokerage?
Mitch Harwood. It happens to me a lot. Don't add the extra D.
What did I say?
You said hardwood.
Well, you are hard.
Okay.
Look at it. Look at the gym that he's been doing out. You have buffed up a lot since you've been with us. Well, how many kgs you put on?
Because I eat more.
I'm saying that in a good way.
12,
like muscle. Actually, sorry, muscle.
Muscle. Okay, thank you.
So how much muscle have you put on?
Well, I don't know exactly, but I'm about 12 kilos heavier than when I started.
Really?
Yeah. So it's
Jesus.
a bit of a difference.
You are a bit. You probably could be a bodyguard at SW Brokerage.
Okay, well, this doesn't work out. We'll see.
Mate, anything else you want to quickly speak about?
I mean, I think we've kind of covered everything, but I guess the last point that I just want to hit home again is, with interest rates coming down next year, hopefully, it is a time for first home buyers. This is your opportunity to get into a home. And people that are already in a home, this is your opportunity to make sure that you are getting the best deal and to set up your financial future, because you need some help along that journey and we're here to help you. So be proactive and make sure that you are getting what you need to make your financial future what it needs to be.
Thank you very much, Mitch.
Beautiful. Thank you.
Thank you, mate. You're very detailed.
Cheers. Have a good one.